This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
World Cup and the war with Iran rages on, and this week on the Wise Investor Show, we'll look at what's driving spending beyond the concerns of the day, but what actually might last for years to come, and why one major Wall Street firm is remaining so bullish. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. I was determined to add some new material this week, and the markets aren't doing me any favors in that endeavor, as it really is still largely about monetary policy and the on and again, off again war with Iran and how that affects prices, and again, the Fed, and of course, AI. So I'm going to pivot in a bit to two specific stocks instead, one of which we don't actively own and one which we do. But first, I'll give the obligatory look at what the market's seen over this past week. And on Wednesday, we did get the minutes from the Fed's last meeting. And really, the markets weren't largely affected at all at the time of the release, as they were already trading sharply lower for the day. But while the prevailing message from the new Fed chair is that he intends to play his cards closer to his chest, he doesn't want to provide forward guidance, which was a running joke during an interview he recently gave over in Sintra, Portugal. But what the minutes did show on Wednesday, according to a piece written about them in the Financial Times, quote, financial reserve policymakers broadly agree that some policy firming would likely be warranted if inflation remained elevated as price pressures dominated Kevin Warsh's first meeting in charge of the U.S. Central Bank, end quote. And this, coupled with the end of the ceasefire with Iran, as of the time of this recording at least, led oil prices higher and likely contributed to a broader sell-off in the markets that day, as well as higher yields in bonds, as the core driver of the inflation pressure in the economy, the higher energy costs, well, they do now appear to be at least sticking around for a while. The Financial Times went on to say, quote, most of those present pointed to scenarios in which the labor market remains stable while AI-fueled demand, the war in the Middle East, and the effects of tariffs could keep price pressures elevated, end quote. So they've moved well past the stance 6 months ago where the official language was pointing towards that the next move was going to be an interest rate cut. And if the pressure on energy prices don't resolve while also unemployment remains rather benign, instead a hike in rates is coming later this year, or is likely to come this year. And that's what the markets are currently priced in, which may not stop or even slow, though, the demand for the capital to pay for all this feverish expansion in AI infrastructure. But it's going to increase the costs of those that are borrowing to build out that infrastructure. And it's going to reflect a taller hurdle for those that are already being questioned about their returns on all of this investment. We also received a JP Morgan mid-year report and updated forecast this week, and they remain pretty bullish, saying out of the gate in the report that they, quote, maintain our view that the global expansion remains on solid footing, end quote. That businesses are feeling more optimistic as they believe they've moved past the fears from last year of global trade disruptions, moving on from them. Well, that was the theme I mentioned many times in this podcast as 2025 started and then moving along. And JP Morgan's key theme is that the market will successfully navigate the tensions and challenges of a global energy shock, and that instead continue to be bolstered by this really strong labor market and the boost from all this AI-related spending. Conversely, the Wall Street Journal published an article this week in which they actually questioned if investors maybe are going to finally blink, is the term they used, as they pointed to the plan that Meta has unveiled to rent out a chunk of their computing power as a possible sign that maybe some big tech, these hyperscalers, may have potentially overbuilt and overspent, hence renting out chunks of what they've built. Ultimately, though, the Wall Street Journal concluded that it really doesn't seem likely that the spend is stopping anytime soon, and the CapEx plans are pretty transparent for what lies in the immediate future. but rationalizing that spending is becoming the bigger theme. And you're going to hear more of this. It's more and more part of every conversation now. And it was notable in an interview from the OpenAI founder, Sam Altman, this week, who seemed to focus more on the efficiencies and the cost improvements in their new AI models, more so than focusing and emphasizing the greater and greater capabilities of the new additions. Still, though, before I get back to what JP Morgan had to say, it's also worth noting that the IMF put out an updated outlook of their own this week, where they cited a lower expected rate of global growth, down to about 3% globally for 2026 from their previous forecast, also down from a 3.5% global growth rate in 2025, as they cite the Iran war as the primary concern. And this was actually published before the latest collapse in the ceasefire. So even when the ceasefire existed, they were somewhat pessimistic. But back to JP Morgan, they're very U.S. focused for economic strength right now, as the country, they say, is maybe the best positioned to handle energy shocks, and that we're at the center of AI spending and continues to be bolstered by resilient consumer spending, the latter of which I would say would be easier to depend on if energy prices at least remain where they are and don't see worser days ahead, and don't eat into household spending accounts, which was cited as a reason for a poor quarterly report this week from one of the major consumer brands, which actually blamed the cost of fuel on their disappointing sales of snack foods, if you can believe that. Back to the Morgan report, though, they maintained a constructive outlook for equities overall, particularly in the U.S., seeing strong corporate earnings, AI-driven capital expenditures, and continued economic expansion, supporting expectations for further gains, despite what they say is periodic volatility. And the market's consensus agrees that it doesn't seem particularly expensive today, especially with many of the heavily weighted leaders in the S&P 500, most of them down a bit from their recent all-time highs, as the FactSet Earnings Insight Report noted that the index is now trading right at about 20 times the consensus forward earnings forecast, which is right at about the 5-year average and less than 1% ahead of the 10-year average, while the same consensus group there currently expects revenue growth for this full year of right on the dot of 10.8% is where they are, and an earnings growth rate expectation of 24.1%, which is considerably higher than the 10-year average, albeit us at the 10-year average multiple. JP Morgan went on to conclude that caution, though, is warranted. We always say that. They say it's warranted because market leadership has become increasingly concentrated in a relatively small group of technology and AI-related companies, and that this concentration raises the likelihood of sharp market swings because you have one little sector, well, one big sector, dominating the whole index. If that sector swoons, the whole market will for sure. However, they emphasize that fundamentals remain supportive enough that market corrections per them are generally to be viewed as opportunities rather than signals of any impending bear market. Essentially, that there's enough that can go wrong to create the volatility, namely on these geopolitical fronts, but they're not substantial enough to create a recession or prolonged downturns. And they, JP Morgan, would be buyers in that volatility because the underlying conditions are such that improvements in these somewhat artificial economic impediments are achievable and ultimately leave the risk more to the upside right now. They updated their price target on the S&P 500 to 7,800 points by the end of the year. That's about 3.5% higher than it's trading today. And they said that they're now bullish on the U.S. dollar, which is a reversal from where they stood at the end of last year, and conclude that the Fed is not going to hike interest rates this year, which is not what the current consensus is. But in fact, they said that the market is pricing a hike, though, which won't occur. And this is a reason for their dollar bullishness. But they actually do expect then that the Fed is going to hike next year, which the general consensus is that there's still maybe potential for cuts next year. All right. Anyway, that's it. Enough of this macro mumbo jumbo for me this week. Going to take a quick break here, but when I return, I'm going to take a look at a couple of companies that are pinging our radar right now. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Remember when AI stocks went up every day and massive tech spending was rewarded? How do you separate an abrupt shift in sentiment from business reality? Are now weak tech names opportunities or to be avoided? Tune in every week as we discuss the latest financial trends and what investors need to know. To filter out the headline noise and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James and Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. One company, which, by the way, I actually don't own, and while it may appear in some clients' accounts, it's not one which we've been active buyers of for many years, and it's Northrop Grumman, which, with some of the recent news flow, it's captured some of our attention lately. In fact, as a side note to the obvious signs of military expenditures and needs for restocking, I guess, the war with Iran, as well as the news flow out of the Nato meetings this week, there was also an interesting piece in the most recent issue of Foreign Affairs in which Rose Gottemoeller examined some of the failures she sees in recent events, failures of nuclear deterrence, and where military investment is needed and where it's squandered. Ultimately, it's not very handy for a pure investment approach, but it's an interesting analysis of what policymakers have done and what they should do and expect in terms of both deterrence as well as active defense. And one player at the center of a lot of these themes is Northrop Grumman, obviously a major U.S. defense contractor, whose two biggest current programs, and for many years to come, it seems, are their contract to rebuild the ground-based missile component of our nuclear triad, as well as their contract to build and deliver the new generation of stealth bombers, which are actually expected to start flying in 2027. And it's worth noting now that Northrop is expected to release their second quarter results soon on July 21st. Their first quarter results were out in April, and today the stock is trading at about 20% lower than it was right before that earnings release, which at the time, that earnings release was a beat on earnings and revenues versus the current forecast at the time. And maybe that's why it's showing up on this radar, in addition to the apparently increase in global demand for defense spending, as earlier this year, the stock was trading at a premium to both the S&P 500 as far as an earnings multiple, as well as its own 5-year average forward PE multiple, which here in July, it's shown on FactSet to be trading at about 10% discount to the S&P 500 and about the middle of its 5-year range as far as forward multiples. In response to those earnings in April, Goldman Sachs, who has the stock ranked neutral and has a price target of $635 a share, they lowered that from their previous target of $740 a share. And in their analysis, they said that Northrop is sacrificing near-term cash flow with increased capital spending in order to benefit future growth, which Goldman, in that same paragraph really, said was a good thing, but that investors need more clarity about the return and timing on that CapEx investment, which makes them sound a lot like they're one of these AI businesses instead of a bomber and a missile business. Goldman does note that the contracted amounts for Sentinel, which is the nuclear missile system, and the B-21, which is the new bomber, and also the contract for missile defense does provide clarity, as combined, they amount to over 30% of current revenues. But Goldman points out that Northrop forecasted a $200 million increase in CapEx in order to accelerate the delivery of the B-21s, and therefore the company did not reaffirm their 2027 cash flow guidance. And Goldman said, quote, "We do not know just how much higher CapEx will shave off prior free cash flow expectations," end quote. And they're defaulting instead to modeling in the lower end of that previous guidance. JP Morgan had a pretty similar report in reaction to that earnings report. They too ranked the stock neutral, but said that the company has exposure to the best growing parts of the defense budget. They hesitated, though, because they also note that it carries amongst the highest price to free cash flow valuations within the defense sector. Worth noting, though, for the longer-term outlook, the Sentinel contract has grown far beyond the original forecast when they won the deal back in 2020, so much so that it incurred a mandatory additional Pentagon review back in 2024. But according to many publications, but in this case I used National Defense Magazine, it was recertified and saw the projections go from $78 billion to $140 billion. And this was because the original scheme was expected to utilize a good deal of the Minuteman missiles infrastructure, the silos and launch systems and whatnot. But updates to the project made that seem impossible, largely, and it reduced much of that possibility. And delivery of that system is now pushed out into the early 2030s from what was originally scheduled to be around 2039. In total, according to company releases, their working backlog on existing defense programs is now approximately $100 billion, and company margins have improved now to 10.8%, in the most recent quarter, with the company guiding to more than 11% for this full year. Moving on, and to wrap up the show this week with a stock that I do own and which we do own for our clients. So, basically what we'd say when we're saying that is you got to also do your own research. We have a bullish positive bias here, so you should be consulting with your advisor and checking our math before making any decisions about what you may hear on the show. But I want to take another quick look here at Netflix, symbol NFLX, which is trading lower on the year, seeing a pullback when they were initially a pretty sharp pullback when they were competing to purchase one of the major Hollywood studios, ultimately which they lost out on. But the stock continues to lag, trading close to where it initially was 2 years ago. They too have earnings coming up, expected to report their second quarter results on July 16th. And in April, they released their first quarter results, which beat the FactSet forecasted numbers on earnings and revenues, both by over 50% versus the expectation. At the time, an analyst from William Blair said they're beating on performance due to the success of higher prices for subscribers, and that they still see an ample runway ahead, and that Netflix has only addressed less than 45% of the total addressable market. An analyst at BMO noted that the stock is lagging because while better subscriber revenues are driving revenues higher, an absence of the company increasing their full-year outlook is counterbalancing the gains that they're otherwise showing. Overall, according to the information FactSet has aggregated from Wall Street, the company is expected to generate over $13 billion in free cash flow this year, over $14 billion next year, almost $17 billion in 2028, and almost $21 in 2029. All while the same consensus has their cost of sales dropping sharply as a percentage of sales for the full year, which is what's reflected in that free cash flow equation, but all amounting to an increasing free cash flow yield off the current valuation on the company, which is about $323 billion. Goldman Sachs, who currently ranks the stock a buy, and they have a $110 price target on it, they note that advertising revenue is becoming a more important contributor here, seeing it scale from about $1.5 billion last year to $4.5 billion expected next year and up to $10 billion by 2030. And that would account for over 20% of the sales in total, which the company is producing right now. Goldman expects them to continue this trend and drive also subscriber growth by continuing a larger and larger focus on live events. And Goldman also notes that the current authorized share buyback program is going to amount to over 10% of the current company's float, and that they should align back with their historical average of using roughly 90% of free cash flow for share buybacks. On the bear case, though, Goldman did throw in that, well, what may be obvious, that any impact to subscriber growth would impair Netflix's results, but also they noted that any major acquisition like the one they attempted could be at least a short-term impairment, which is what the street may be pricing in now as Netflix attempted such a major purchase earlier this year. Nonetheless, other major deals in the industry this year have reduced the number of streaming options for the consumer, and that may result in a less competitive environment overall for the same consumer dollar. And Netflix is now trading at less than 20 times this year's overall forecasted earnings. All right, that's it for me this week. I'm Chase Hinderstein for the Wise Investor Show. As always, thank you for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.